Gold is sitting just under $4,000 an ounce, and that number should feel momentous, but it doesn't, which is exactly the problem. When an asset that was supposed to be the ultimate crisis hedge starts feeling boring at all-time high territory, the market is telling you something. The question is whether gold is taking a breath before its next leg up, or whether the smart money has already begun a quiet, methodical exit, and retail hasn't noticed yet. Round numbers in financial markets are not just cosmetic. They are decision thresholds, levels where a significant number of market participants have pre-committed to reassessing their positions. $4,000 per ounce of gold is one of those levels. Here is the structural reality as of June 2026. Gold has hovered around $4,000. That word hovered is doing a lot of work. It means the asset has approached this zone, found it technically sticky, and has not been able to generate the kind of sustained buying pressure needed to convincingly break through and hold above it. That is a meaningful distinction from a brief overshoot and pullback. Now let us add the macro context from today's headlines. Inflation data came in line with expectations. That phrase, in line, is quietly one of the most bearish things you can say about gold in the near term. Gold's most powerful tailwinds have historically been inflation surprises to the upside or genuine fear about financial system stability. When inflation prints exactly where the Federal Reserve and bond markets anticipated, the urgency to hold a non-yielding asset as a hedge diminishes at the margin. At the same time, Nasdaq futures are up 2% on Micron's earnings beat. Capital is rotating. When tech earnings surprise to the upside and inflation behaves, investors face a real opportunity cost question. Do I hold gold, which pays no dividend and yields nothing, or do I move back into productive assets that are demonstrating earnings power? The actionable insight here is this: watch the real yield environment closely. If 10-year Treasury inflation-protected securities yields are rising alongside stable inflation data, that is historically one of the clearest pressure valves on gold prices. The $4,000 level is not just a number. It is the market asking whether the conditions that justified this rally still exist. Silver holding below $60 while gold sits near $4,000 is not a secondary storyline. It is arguably the most analytically rich data point in the entire precious metals picture right now. Here is why. The gold-to-silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, is historically one of the more reliable sentiment and cycle indicators in commodities. Historically, the ratio has oscillated in ranges that reflect both fear cycles and industrial demand cycles. When gold dramatically outperforms silver, it typically signals one of two things. Either the rally in precious metals is primarily fear-driven rather than industrially grounded, or the broader risk appetite for commodities is weaker than headline gold prices suggest. With gold near $4,000 and silver still below $60, the ratio is elevated. Silver is not confirming gold's strength. This is a divergence, and divergences in financial markets deserve serious attention. Why does this matter practically? Silver is simultaneously a monetary metal and an industrial metal. It has significant demand from solar panel manufacturing, electronics, and electric vehicle components. If silver were genuinely rallying in sympathy with gold, it would suggest that both fear-driven demand and real economic activity were reinforcing the same thesis. The fact that silver is lagging suggests the rally in gold has been more about macro hedging, central bank buying, and dollar dynamics than about a broad commodity supercycle. Meanwhile, today we see retail investors piling into Wendy's stock as a meme trade for the second consecutive day. This is a useful contrast. When retail capital is chasing fast-moving meme narratives, it tends to drain speculative energy from slower-moving asset classes like silver. The actionable read: silver's underperformance is a warning label on the gold rally, not a buying opportunity in isolation. Step back from gold and silver for a moment and look at what is moving today. Because markets are interconnected, and capital rotation is the real story underneath these individual asset prices. Nasdaq futures are up approximately 2% as of this morning, driven by Micron's strong earnings and that inline inflation print. That combination, earnings outperformance plus non-threatening inflation, is essentially the most favorable short-term setup for growth equities that you can construct. It reduces the Fed's urgency to tighten, it validates AI-driven semiconductor demand, and it gives institutional allocators permission to increase their risk exposure. Simultaneously, Wendy's shares are surging for a second consecutive day as retail investors adopt it as their current meme vehicle. This is worth noting not because Wendy's fundamentals suddenly changed, but because it illustrates where speculative energy is flowing. Retail is in risk-on mode. They are not buying more gold coins. For precious metals, this environment creates a specific type of headwind. It is not a catastrophic collapse scenario. Gold does not crater when tech rallies. But the incremental buyer, the person on the margin deciding between adding to a gold position or rotating into semiconductors, is making a different decision today than they were 6 months ago, when inflation was less predictable. Here is the framing that matters for anyone thinking about their own portfolio positioning. And to be clear, none of this is financial advice, only analytical context. Gold near $4,000 in a risk-on environment is a different asset than gold at $4,000 in a risk-off environment. The price is the same. The conditions are not. The question you should be asking is not whether gold is expensive or cheap in absolute terms. The question is, what macro regime are we entering? And does gold belong in that regime at its current weight in your thinking? We opened asking whether gold's stall near $4,000 was a pause or a peak. The honest answer, based on what the data shows today, is that the conditions supporting the rally are softening, not collapsing, softening. Silver is not confirming the move. Inflation behaved. Tech is outperforming. The next question worth asking: if the dollar weakens materially into year-end, does gold get a second wind? That is the next video. Subscribe so you do not miss that analysis when it drops.